Hello and welcome to a live Goals Masterclass webinar series on Moneycontrol.com. In today's session, we will be talking about ULIPs as an investment avenue during the economic recovery phase post the COVID-19 induced slowdown. Offered by life insurance companies, these products allow you to invest in equity and debt, although majority of investments do flow into equities. With equity markets at record highs today, this product has come into focus yet again. Now, in the past, of course, ULIPs have faced their share of hiccups with their chart structure being called into question. But they have evolved into relatively lower cost products over the years, thanks largely due to IRDAI's product regulations. ULIPs hold an edge over mutual funds in terms of tax structure. But on the flip side, of course, flexibility is relatively limited as well. To know more about ULIPs and their role in your investment portfolio, we are joined today by two veterans in the insurance industry. Sampath Reddy, Chief Investment Officer, Bajaj Allianz Life Insurance, and Rohan Sachdev, Consulting Leader, India Region for EY. Welcome to the show, Mr. Reddy, and welcome to the show, Mr. Sachdev.
Right.
It's great to have you here.
Thank you for having us.
Thank you.
So, Mr. Reddy, if we could start with you first. Now, investors have faced tough times during this initial COVID hit period. What are the key lessons you think that we can learn from this pandemic when it comes to handling our finance and investments?
Right. Even during the pandemic and even during the lockdown, we have had reached out to our customers many times, and we've been arguing that even if the lockdown were to be quite severe, and even if the economic downturn were to be severe, the stock markets need not have to fall so much. Given that equity market or the stock prices are actually a function of long-term free cash generation of the business. So even in that context, even 1 year's return were to 1 year earnings were to be washed away by the pandemic or something like this, if the underlying value of the business won't change so much, probably about 5 to 6% kind of a decline would be there in terms of intrinsic value of the firm, even if you knock off the earnings by the to the zero for the first the first year, which is what has actually happened. In fact, markets have fallen a lot during the month of March, April, and subsequently they have recovered quite well. So pandemics like this, if the markets reacted excessively and fallen a lot, in fact they ended up becoming a good opportunities in the past. And the same thing we have been advising to the customers, and thankfully markets have recovered quite well. So that's how don't get disheartened by a substantial decline in the markets because of one-off events. Underlying business of the underlying strength of the business is not going to dramatically altered by 1 year earnings or couple of quarters of severe lockdown. So that's what has been our advice. Don't use this as actually as an opportunity to deploy more. That's what I would like to comment on that.
Okay. Mr. Sachdev, if you could come in on this as well. Now, we are told that we should never waste a good crisis. So, what are the do's and don'ts that investors can pick up from this crisis?
So I think first of all, Preeti, to your question, I think first, rather than being an investor, I think first as an individual, I think what the crisis has taught us is that we should all build a contingency fund for 6 to 9 months. I think all of us have learned that, irrespective of which class of society we come, that build a contingency fund. Then I think as you look at your portfolio, whether it's an investment portfolio or your savings portfolio, I would say, let's not immerse ourselves in excessive debt. If you're in excessive debt, it creates a real issue. I think third, I would say, is people need to sort of think about insurance, whether it is life insurance, whether it is health insurance, whether it is investment-based products. I think they need to think about investments that is going to help them and hold them in steady state. Fourth, I would say, I think really from our perspective is, start thinking about personal budgeting, start thinking about managing your spend effectively. I think this one pandemic has taught people that, how do they rethink expenses that are not required, expenses that are frivolous. How do you start retaining yourself in that sense? I think the other one I would say is, I think a lot of realization has come to people from a sort of a nomination of a successor perspective also. I think we are, as Indians, we are very sort of lazy in that regard. So I think that has also become something that has become a lot more pronounced. So I think that one thing is there, that is the whole behavioral change, Preeti, that we will need to sort of think about. I think the second one is to what Mr. Reddy said is, I think people have to sort of not panic in these times. Think through, that there will be a recovery, but that is also balanced off with what their financial condition and their liquidity state is. So that's what I would say in terms of an overall picture.
Okay. Okay. Uh, Mr. Reddy, coming back to you, have you noticed any specific trends or patterns when it comes to product preferences and investments during this period from policyholders?
Not really major change, just that equity returns have been muted because of the significant fall in the markets during the month of March, April. Initial few months of the current financial year, when the equity markets were quite depressed, customers at that point of time were actually preferring the non-par product, non-participating products. These products offer actually the guaranteed return to the customers. A lot of customers were actually preferring the guaranteed return products. During the first quarter of the current financial year, but of late again with the markets recovered, again the customers are now looking back into the equity products as well. To answer your question on the redemption as such, we have not seen any redemption in the during the even in the first half of the current financial year when the markets were down, because as you know that unit linked products are a minimum 5-year lock-in kind of a product, so there is no such thing called redemption as in our case, but the customers do have an option to shift towards the debt funds. Like if a customer has invested with us for in an equity fund, but he is, let's say, is committed to invest with us for a minimum period of 5 years. In a situation like this, if he's not happy with the equity product as such, he could move his money within the unit linked fund itself. He can move his money to the debt fund or a liquid fund. Even that trend also we have not noticed much. As such, existing investors were pretty much, I would think that they were stable without any redemptions or a shift towards the debt funds. But the new investors and customers were preferring the guaranteed return products during these times.
Okay. So you did not see any significant surrenders during this period, you mean ULIP surrenders, that is?
No, not really at all.
Okay. 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 And of course, insurance companies also saw a spike in demand for health and term insurance products during this
Correct.
period, as understandably the focus was on protection. So,
Absolutely.
right. So, Mr. Sachdeva, what according to you is the primary role of insurance then? Just protection or protection along with wealth creation?
Well, I think two things to say over here, Preeti. One is, if you ask me the answer, I think it's both. One is protection, the other one is wealth creation. But I think there are different needs for different age segments. And I think, as Sampath said, when term was coming in, it is more looked at from a protection perspective. But if you look at ULIPs, they have both of a protection element, and I think they also have a investment element. Now, as you mature and you go through life stages, you need to have both. As you have families, as you have education needs for the families, as you have other commitments, and as you reach retirement. So I think my answer will be that insurance needs to be a combination of protection and wealth creation. Now, I think also you've got to understand that the insurance policies in our country offer certain benefits. So I think the ULIPs have come a long way from where they were before. If you see what happened in the financial crisis, and after that, after the ULIP policies changed, I think the ULIPs have come a long way. Today, they are the exempt category. You will not find anything else that is sitting in the exempt category. They are reasonably transparent. You can understand the terms and conditions pretty easily now. They also have an element of protection, and they have an element of insurance built into them. So that's, I think, one side. On the ULIP side, again, the switches are pretty easy, and you don't pay for the switches. So that's another one big benefit of ULIPs. Whereas even if you go to an NPS, and I'm not saying it's good or bad, but I think even the NPS, you will have to pay the annuitization in there. So you have to pay for that. That is in there. So I think where our insurance industry is evolving is that it is providing enough opportunities for people to pick different types of, whether they have only an investment need, they have an investment and protection need. But I would say, you should always go for a joint an investment and protection that will be there. Again, as Sampath was saying, term is really great for protection. And then, the LIC with the participating endowment that they have is again, the returns on that have been better than fixed deposits over a period of time. So I think you've got to pick and choose your portfolio well. You've got to think through what your needs are, and you can use insurance effectively for both purposes.
Okay. In fact, my next question was going to be on the evolution of ULIPs over the years. So, Mr. Reddy, could you elaborate a little on the new age online and low-cost ULIPs that we've seen over the years, and how do you think they are better than their previous versions?
Right. I think, prior to the 2010, I would say that, ULIPs were quite an expensive way of, managing the, funds. But post 2010, things have improved dramatically. The costs, IRDAI has capped the, expense ratio overall that a ULIP can charge to the customer. And not only the IRDA capping of expense ratio, but the participants among life insurance participants among themselves have also been, brought down the overall expense ratios dramatically in the last few years. In fact, the I would say, pretty much, some of the low cost unit linked funds, if you remove the cost of mortality alone, they are pretty much on par with some of the, the direct direct savings platforms that you could get into alternative the players such as mutual fund industry or other or AIFs or a PMS kind of structure. In fact, it is I would say in some cases probably it is even the even expense ratios are even not only comparable, in fact better than some of the other industry players as well. So overall, expense ratio has come down dramatically in the last several years. The low cost ULIPs actually manage money which is on par with any other platform, if not better, in terms of overall expense ratio that is charged to the customer.
Right. Also, in April, the IRDAI asked insurers to offer policyholders a staggered settlement option for a limited period. And of course, earlier, just before that, new product guidelines that promise flexibility also came into force. Could you elaborate on some of these recent changes that we've seen?
The IRDA sort of allowed for a delay in premium payment, right? But I don't think the IRDA allowed any premium holidays or any premium waivers as they used to allow before, because I don't think our regulatory structure or the product structure has that allowance anymore. And so I think from
Policyholders over the age of 45 were allowed to choose 7 times the sum insured, seven
no,
times the premium.
that's so
Yeah,
sorry. That's
that
a different
the
point. That's a
regulations
different
that
point.
were, yeah, that was what I was referring to. Regulations that
So
were actually rolled out last year and became effective this year.
I think from a COVID perspective, they didn't do that. The only allowance they gave was around that area. I think what happened in the regulations last year was that the 10 times came down to 7 times.
Right.
But then you got to be careful from a tax perspective if it's sitting in that 10 times range. I think some of the other changes that they brought around, which I think, what your question is, what is it that can be leveraged in these COVID times from the current regulations or the new regulations that came through? I think what happened was they also had the ULIP rider premiums, where historically it was based on allocations, but now you can see it as a separate cost for the rider. So it's very visible to the policyholder. So that makes it much easier when a policyholder has a rider. I think the other issue also was, and this was more on the non-linked side, was the surrender time frame was changed.
Right,
So
right,
instead of it was brought down by a period. I think those were some changes. But
three
also
to
they
two.
brought some changes around the revival. So the revival period, from 2 years it went to 3 years. That's what they did, was a good change. Or otherwise, they also said that after 5 years, you could bring your premiums down by 50%. Similarly,
Right,
they changed things on the pension side. I think all of these things, you look at it now in hindsight, it's the regulations came very late. But in hindsight, someone who's sitting at that stage and there is a pandemic, you could actually effectively use some of these measures to sort of get some beneficial advantage from your policies or manage your situation much more effectively if you were in a sort of a cash tight situation. So that's what happened. And then there were some others on the pensions.
idea was to just understand the recent changes that ULIPs
Sure.
and ULIPs have seen. So one was, as I mentioned, that 10 times to 7 times, or anything that you want to elaborate on.
Okay. So, earlier for the revival of the policy for policies for the unit linked products was, 2 years. Now it is being extended to the 3 years. And similarly, the traditional products also, the policy revival time frame from 2 years has been extended to 5 years. That's one change. And life cover for the life cover is, been lowered from 10 times to 7 times, but if you choose the less than 10 times, the tax benefits will not be there. I mean, we can a customer, we can sell the savings product with, seven times cover, but it's not attractive to the customers if they buy, because they will not be getting the tax benefits on the savings and investment returns that their customers are going to have. So that's why, even though the life cover is being lowered from 10 times to 7 times, it is not yet it is not a big positive for the we're not seeing it as a major change, because customers will not prefer the the lower life cover, as they may not get the tax benefit on the lower life cover less than 10 times.
So you mentioned taxation, Mr. Sachdev. So this is an aspect where ULIPs do score over mutual funds clearly. So could you talk about how ULIPs compare with other investment products when it comes to taxation specifically?
No, so I said earlier, I think from a ULIP perspective, I think the one big thing of the ULIP is that it's the exempt. So the ULIP has that benefit that it has an exemption for that, and I think the other advantage it has, not just from a taxation, is that the lock-in period for the ULIPs is 5 years. Now, if I compare them to mutual funds, there is no lock-in period in there. But in the mutual fund, I think there is a there is treated as the redemption, and then there is the capital gains tax that happens in the mutual funds. So I think that from that perspective, ULIPs are far more beneficial, although you have to understand the terms and conditions. I think then if you compare them to the ELSS also, I would say, one of the benefits that ULIPs carry over the ELSS is that, there is a tax of 10% over 1 lakh over there. Again, fixed deposit,
Right.
I think, would be a tax. So I think you've got to think through. I think you can't just take one tax benefit and compare it to the other tax benefit. You have to also measure up what are you buying the for, and what are the overall benefits that are coming through from you. ULIPs obviously have the tax, which is exempt at the investment stage, at the accumulation stage, the input stage, and at the payout stage.
Right. And how do you rate ULIPs as an investment tool for achieving long-term goals in particular? And what role can it play in my investment basket along with other instruments?
I think, as I said earlier, you've got to decide what your see. One advantage is ULIP, and I think Sampath said it. Depends on your risk profile. You can either go for a debt one, you can go for a balanced one, or you can go for an equity. First of all, it depends on what's your risk profile and what you expect as a return in that. Secondly, obviously, I think over a period of time, and again, Mr. Sampath spoke about it. After the 2010 regulations, they become a lot more transparent. There's a lot of transparency in there. The switching allows you to have a lot more flexibility without charging you for it. Then the 5 year lock-in, only 5 year lock-in, allows a lot more liquidity over a period of time. So I think from how I look at it from a portfolio perspective, I would say, there are no surrender charges, there's transparency, and with the sort of net reduction in yield concept also, that is helping. So I would say it would play an important role in my portfolio. But at the same time, you've got to balance the portfolio with your lifestyle needs. But I think it's a good one to have in your portfolio if you want to get the benefits of the market and also get protection at the same time.
Okay. Okay. So coming back to you, Mr. Reddy, what are the key points that policyholders should consider before investing in ULIPs? Now, the reason why I ask this question is because although they are meant to be long-term products, the fact is that many do drop out after 5 years, immediately after 5 years, or even before that, in fact. So before committing to ULIPs, what are the points and risks that they should bear in mind?
Yeah, so one should, customer should be aware that unit-linked products are somewhat long-term oriented savings, and there is a minimum 5 years of lock-in period, and also the customers, if opted for for a 5 year, 5 year pay, which is typically a regular premium product, they must pay for the 5 year period. Otherwise, it gets, the policy gets, money gets moved to the discontinued fund, where the expense ratio could be relatively, higher. That could be one thing. So the first point is that, it's a long-term product, so the minimum is 5 years is the commitment that customers should be aware. And second thing is that, the most unit-linked product, most insurance companies under unit-linked platform offer, reasonably diversified investment styles. So today, if a customer, chosen unit-linked product of ours, he's invested money in a large cap fund, and tomorrow after he doesn't have to worry that, he's committed his money for 5 years, in the large cap alone itself, or 1 year down the line, if he feels that mid caps are more attractive, he can choose, he can shift his money towards mid cap fund. Or if he thinks markets are overvalued, want to cut down his exposure towards equities, he can, move his funds from the equities to the debt fund or a liquid fund. Or tomorrow, if the duration is attractive from the fixed income side, he can go and buy the long duration fund. So overall, customer should not only look at the expense ratio, but he should also look at, are there sufficient number of investment strategies and styles that are offered in the ULIP product. Let's say in our case, there are 7 differentiated funds. We offer in a unit linked product. Customer can choose any of those products, whether it's a large cap fund or the mid cap fund or a flexi cap fund, or a debt fund or an equity fund, or a liquid fund or a balanced fund. Or if he doesn't like if he thinks that fund manager are not adding value, he can actually buy passively managed fund also. So customer can the customer need not worry about committing for 5 years to one particular style or one particular fund. He can shift between his funds between the asset classes without any cost as well, without even any cost, and without even having to subject to himself, going through the transactional, reporting the transaction for the purpose of, the taxation. So moving between the funds is not considered as actually the taxation. You can shift between the funds so easily. Only at the time of you paying the premium that will be counted, for the purpose of your outflow point of view. So it is, once you put the money in the unit linked fund, you can seamlessly manage your asset allocation without really any tax implication. That's an advantage. But the customer should be reminded of that he's committed for a longer period of time, which is a minimum 5 years. These are the important factors that you should notice. And of course, expense ratio and the mortality cover. And the mortality cover is a very important thing. Unless the customer chooses for a 10 times cover, he will not get the tax exemption. So that these are some of the important things customer should be aware of it.
So in this current phase, when the economy seems like it has started to recover, what are the points that investors should bear in mind while investing in general? I'm not specifically talking about ULIPs.
India has got a very strong potential for the growth. I mean, if you look at the performance of Indian equity markets, from the March lows, we were one of the better performing markets globally speaking, with almost 50% return from the lows, the March lows. So in the longer term perspective, Indian equities are reasonably well placed. They offer very good hedge towards the inflation as well. Even in the last, if you look at the fund flow in the market rally in the last few months, significant part of the rally is driven by the foreign institutional investors' money. Just in the last 2.5 months itself, FIS have put almost about 1 lakh crores of money into the Indian equity markets. That shows that India's attractiveness over among the global funds as well. So overall, in spite of the one-off events like the pandemic situation like this, India offers a very good long-term potential. Indian equities offers a very good long-term potential. We have a very diversified sector presence in terms of our stock market. Very few countries across the globe offers such a wide range of spectrum in the listed space, such a wide range of spectrum of companies in the listed space. So it's a very good. We have a very good pool of companies and a very well regulated system. I think equities as such is a very good savings vehicle, and within that, the platform like ULIPs offer attractive play for the customers to participate in the Indian equity story. So there will be ups and downs in any economy. Sometimes because such things like the pandemic has put a brake to the growth towards the economy, but it is going to be temporary. It's not that it's going to puncture the India's long-term growth potential per se. Yes, because of this, this financial year, instead of probably growing at 5-6% GDP growth, we probably could decline somewhat in this financial year. But as such, when the once we come out of this pandemic, which we are already in the process of recovery, next financial year is again going to be a very good growth for the corporate earnings as well. So overall, there will be periods where the pandemics like this or any other any other events could lead to a temporary slowdown in the economy. But that should not deter the investors for the longer term perspective. Equities offers a very good returns in the longer term. I think that's what investors should keep in mind.
Okay, okay. Mr. Sachdev, would you like to add anything on investments during the recovery phase?
No, I think what Mr. Reddy is saying is, I think, absolutely right. So I think my only thing is, I would say I totally agree with what Mr. Reddy is saying. I think India has a great, solid foundation. I think, so the fundamentals of our country are super strong. Foreign investment is continuing to come in. So I think that will just allow us to flourish further and further. But I think the learnings from I think you asked the question about the investments. I would say I'll go back to my first answer. The learnings from the pandemic would be such that we should think about what is there from a liquidity perspective, what is there from a stability perspective, uh, and also what is there from your own lifestyle perspective. Because I don't think necessarily we are out of the pandemic as yet. I think we are going through a phase of the pandemic. The pandemic is still, if you look at what's happening in the US, even yesterday there were 3,000
Right,
deaths.
right, right.
So the pandemic is still hovering around. The vaccine is there. God knows how many people will get it, when we will get it. So I think we've got a few months before we come into, I would say, a stable state. I think the markets are doing very well. So my only advice would be think carefully, understand products very, very carefully. One example on the ULIP side is understand when you can actually get the tax benefits. You don't get the tax benefits, in all instances. And then people come and complain about mis-selling because of it. So, understand the product, think of your own personal portfolio, and then invest. But I think, um, uh, I would just close by saying, the future is strong, and so we should take a thought through, but we should take this step forward towards investing into the market.
Mr. Reddy, could you talk about the sectors that you think hold great potential this financial year and next? I know it's a little difficult in the context of the pandemic with things being in a flux, but which are the sectors that you are betting on?
As you see in the last few months, the rally is in equity market rally is somewhat, I would say, broad based. Prior to the pandemic, if you recall, the markets were somewhat narrow, and select few companies and a few large companies or a few high quality companies where the growth is there. Be it from consumer or a top tier private banks, etc., were only performing, and they were only holding up the market or driving the market up. But after the recovery from the pandemic lows, from the March April lows, especially if you look at it, I would say some the performance of the equity market is somewhat broad based in the last few months. In the During the current financial year, during the initial part of the time, pharma and IT sectors have done very well, and followed by then after that, the banking and financial services have recovered, and of late, metals and cement sector have also performed pretty well. So overall, gradually, as we open up the economy and as the demand is improving, more and more sectors are participating in the rally. I would think even the small and mid cap companies in the last a month or so, they're also participating in the equity market rally of late now. So this rally in the last couple of months, especially the recovery from the March lows, is now somewhat broad based. Having said that, we've been liking some of the sectors like export oriented companies, whether it is IT or a pharmaceutical companies. We've been liking that sector, especially the pharma has undergone a severe, the correction over the last 3 years, and most of the pricing related pressures are now behind in the US geography. So pharma sector we've been liking that. IT services also, valuations are quite attractive. Most of the companies are quite large and highly cash generative companies with a very good governance practices, trading at attractive valuation. That sector also we've been liking. And within the banking and financial services, we've been always preferring the top tier, private sector banks. They are well capitalized, well run with a very limited, NPA related issues. So we've been liking the top tier, the private sector banks also, and even the telecom is also on the recovery path, especially in the the ARPU is pretty much like a bottomed out. It's just the pricing pressure which was there for the last several years now getting eased there in the telecom side. So there are quite a few sectors we've been liking it. Its only thing is probably one of the sector which is still lagging the in terms of recovery is probably the capital goods or equipment makers. The private sector capital spending has been somewhat absent for quite a few years, because of which the overall capital goods companies have been somewhat I would say poor performers. But in terms of valuations, in terms of cyclical recovery point of view, even the capital goods also not too far away. Probably when once the 6 months down the line, once the economy comes back into the full throttle, so we would also see the capital goods equipment makers also would participate in the rally.
So is that one of the sectors that you will be staying away from in the near future?
No, I mean not really, because in terms of the even though the growth dynamics are yet to play there, share prices are pretty much factoring in worst case situation. We would be actually, I would say, we would be keenly watching that space to increase the allocation as and when we see the
Okay.
signs of the private sector capital, private sector's capital spending, beginning to happen.
And any sectors that you are avoiding at the moment that you're not looking at?
Uh, I mean, not really as such. There's no major sector, where maybe we are somewhat, certain places we'll be somewhat underweight, but there's
Hmm.
no, really, avoiding kind of a sector as such.
Okay. 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 And finally, if you could talk about the importance of diversification, even within equities, uh, why is it important for policyholders to diversify across asset classes?
Yeah, I mean, diversification is a very important aspect, because all by and large, every asset class, along with the risk return potential, there are some risks in every asset class, whether it is equity or whether it is real estate or whether it is even the fixed income product like the debt products, etc. So by and large, every savings and investment vehicle or asset class has some sort of risks involved in it. So it could be the nature of the asset class and its return. It could be sometimes even the institutional risks, etc. will be there. It's always good to diversify from the customer perspective, so that in the event of the risk gets caught up in any of the asset classes or any of the products, customers would not suffer the entire loss, so that loss will be mitigated from the customer's end. So that's from the customer point of view. And we as a fund manager also, when we are managing the the assets for the customers, even at the
Hmm.
fund manager level, we also have a very diversified approach towards when we are managing the money, and each fund, by and large, there are even there are regulatory restrictions as well. Regulators themselves also ensure that the portfolios are well diversified by putting certain restrictions and limitations. Over and above that, we as a fund managers have additional limits, such that the portfolios of each fund manager, each fund, are adequately diversified, so that mitigate any drastic impact on any other sectors or any companies. So it's an essential tool. Not only that, fund managers follow at the fund level, even the customer should also look at the diversification aspects whenever they're putting the allocation of their funds to across various platforms and the asset managers.
Thanks a lot for joining us, sir.
Bye bye.
Thank you. Thanks a lot for joining us today, Sampath Reddy and Rohan Sachdev. It was great having you on the show. I'm sure our viewers will find the insights useful. So that's it from us today, viewers. I hope you found the session as insightful as we did. This session was brought to you by Bajaj Allianz Life Insurance. Thanks a lot for tuning in. Do join us for more such informative sessions in the coming days. Thank you and goodbye.